What actually happens after you win the game financially? After the exit, the liquidity event, the moment most entrepreneurs think they're chasing? Why do so many still feel like they're searching for what's next? Welcome back to another episode of the Vital Wealth Strategies podcast. I'm your host, Patrick Lonergan, and today's conversation is one that every entrepreneur needs to hear, specifically if you're building towards or thinking about life after a big win. I'm joined by Tad Fallows, co-founder and managing director of Long Angle, a private, highly selective peer community of over 5,000 high-value net worth entrepreneurs across 45 countries. No fees, no pitching, just real conversations, and over $300 million collectively invested into alternative opportunities. In this episode, we unpack where founders are actually investing post-exit, why many are turning away from traditional advisors towards trusted peer groups, and how your identity, purpose, and approach to wealth evolves after success. If you want to build wealth that actually supports the life you want, this is a conversation you'll want to hear all the way through. And before we dive in, if you want to apply what we're learning, head over to vitalwealth.com/resources. We've built a vault of tax strategy and wealth building tools specifically for entrepreneurs. That's vitalwealth.com/resources. Make sure you check it out. If you enjoyed the episode, be sure to subscribe, share it with someone who needs it, and leave us a review. All right, let's dive in. So I'm excited about this. Tad, thank you for joining us.
Hey, thrilled to be here, Patrick.
So I'm thinking about the challenges that the entrepreneur has that's making healthy income, and we've got a few different issues. We've got an over concentration in our business traditionally. Typically, it's like that's where they hold most of their wealth, and then they're typically holding wealth in their traditional markets, which are kind of boring. And then you also look at where, I don't know, we'll call it the ultra high net worth, the billionaires live, and they have just a broad base of alternative investments. And it's interesting when you look at the data around alternative investments, what they do for your portfolio, they tend to smooth out the ride and increase return. And so we don't need to get into all the nitty gritty details there, but I just think about, the problems that the entrepreneur is facing, and they're unsure if they're making the right moves with their capital. There's you start to get money and it's like, man, there's so many opportunities out there. They're frustrated by, I'll say, the fragmented, noisy investment information that's out there in the world. You also start looking at financial incentives and you're like, who do I know who to trust here? And they're just concerned in general that they might be missing opportunities that more connected investors are accessing. And then, I think about the philosophical problem around wealth shouldn't be built in this like isolation. Investors shouldn't operate alone. They should operate in rooms and have better conversations, better access, better frameworks. And so I'm looking forward to getting into what you built with Long Angle and how that comes together. So thanks for joining us here today.
Yeah, really excited for the conversation. And what you're describing is very much why we started this community. So I started with my co-founder about 5 years ago. And that was really after we had our own liquidity event where we had bootstrapped a software company starting our mid-20s to our mid-30s. It was about 10 years. It was and then we sold it to a strategic acquirer. So basically on one day, we had added 2 zeros to the liquid net worth and had all these new questions, both around investments as you're talking about, but also a lot of other questions in terms of whether that is insurance, whether that's estate planning or more lifestyle things of, okay, how do I biggest question any of our members have is how do I make this wealth an asset and not a liability for my kids? Because a lot of them still have kids around the house. So had all those questions and I felt like the only source of good information was something like a Goldman Sachs or a Credit Suisse. And while they had high quality information, there's just this question of, well, are they telling me to buy XYZ because that drives up their AUM? Or is it because that's really the best thing for me? So we wanted to just start a group of peers who are all in the same situation where nobody's trying to sell each other anything.
Yeah, no, I love this. And I'd love to get into more about Long Angle, and let's just talk about that. Can you tell us about the community that you built? And I think it's also good let's talk about the threshold for who is a good fit to join the community and where we need to be from a, let's say, net worth point of view.
Yeah, so I think banks have these classifications where actually are not bad, where they say high net worth is someone with $1 to $5 million, very high net worth is 5 to 30 million, and ultra high net worth is 30 million plus. Maybe you can argue with inflation they moved around a little bit. But they have those basic categories, and I think we fit really in best in that very high and ultra high net worth category, where typically it's people with more than 5 million tend to find the most value. We have a sort of hard floor of 2.2 million outside of your house, but
Yep.
really around 5 million you start to get to these questions. And then I would say up to probably a couple 100 million of net worth. When you get into the truly, I've got $1 billion, you have a separate set of problems and a separate set of resources. You've got a guy for that. But the
Sure.
person who has 20 million, 30 million, they are you can't afford to start your own family office on that, but you do have a lot of complexity. So a great example is the estate tax. Typical advice if you've got a couple $1 million is, hey, look, the exemption is 30 million, no one ever hits it, don't worry about it. And that's totally accurate, but is not useful if you've got 20 million today and you're 45, you're almost certainly going to be well over the threshold by the time you pass away. So it is relevant to you. So it's those kinds of questions. So I think really that 5 to 100 million is probably the bulk of members, or 5 to a few 100 million.
Yeah. No, that's fantastic. And I really appreciate, when we start thinking about the Goldman Sachs and some of those other avenues that we can go invest our money. I think you're right. We start seeing I'll call them the conflicts of interest start to show up. And there's a conflict for me to uh the advice is directing my dollars to have them manage those dollars, right? And it kind of makes sense because it on one hand, there's a financial incentive. On the other hand, it's like, well, they can only really give you good advice on the dollars that they can see and have some insight into and how they're performing and all those other things. And some of these private investments don't have like clear insight into what's happening or that real estate project or what have you. So, but that doesn't mean it's not best for the client, for the individual to have their dollars invested in those things. Because I think we see there's so much wealth built in private investments. There's better returns from things like private credit from a compared to you know some of the traditional we'll call them interest rate plays. Yeah, so I think there's so many unique opportunities here. And can you give us a little insight into, like, let's say I'm a member and I've got, because we've got a number of clients this year that have exited their business, and they're exactly what you're talking about. It's like, oh, I went from very little liquidity to all sorts of liquidity, and now I'm looking at what do I do with these dollars, and they're getting lots of phone calls from lots of people saying, hey, here's a new opportunity for you to put your money into, whether it's a real estate deal or not. So let's say I've had a liquidity event, or I've just been stacking up $1 million a year and free cash flow that I'm sort of tired of the traditional opportunities. How does that conversation go? How does it work inside of Long Angle where I can start to explore and have conversation around new opportunities?
Yeah, it's a great question. First, I should be clear. I'm not a wealth manager, so I'm not looking to take anybody's portfolio and put an 80/20 into anything. So this is really around
Sure.
the conversations that people have with each other.
Mhm.
And first, I would say I think there is nothing wrong with just saying, "Hey, putting my money in the S&P index fund might be a little boring, but you know what? Over the last 100 years, it's compounded at 10% a year, so you could do worse." I think there's often this sense of, "Hey, now I have 20 million. I need to do something more creative," and I do think it is interesting, and there's opportunities to do better if you tweak with these things. But I don't think people should feel a sense of pressure of, "Hey, I have to do something different." If you're somebody who is comfortable with the so-called Bogleheads portfolio and just sticking all in the stocks, and you can have the stomach to ride out the volatility, it's certainly not. There's nothing wrong with that approach. I think a lot of our members, and I will say that 75-80% of them don't work with a wealth manager. They're people who manage their own assets. Partly that's just because they look at the numbers and they say, "Hey, you may call it 1%. I call that 200,000 a year post tax." So like
Right.
that's a lot of
Right.
money. And then a lot of them are just, frankly interested in it. They'll say, "Hey, I'm a smart person. I was capable of creating this wealth. I've run a business. I understand a spreadsheet. I actually don't think I'm going to do any worse than the next guy at doing this." And so they want to
Yeah.
manage it themselves. But regardless, um, I think where people are often looking to where they want to add more. So we do every year, we do an asset allocation benchmark survey across our members, which is actually pretty cool because it's hard to get data of people with tens of millions of
Yep.
dollars about how they're actually investing their money. And again,
Yep.
across different wealth managers or self-management, et cetera. And I would say public equities are certainly the biggest portion of that. For almost everybody, public equities are the anchor. But if you look at it compared to what you might call a conventional portfolio, they're much less into bonds. People have under 10% of their portfolio in cash and bonds because they're saying, hey, if I'm taking a long game here, I made 10 million by the time I'm 35.
Yep.
I'm much more worried about how that's going to compound over 50 years than exactly how smooth that path is. So they tend not to do that. They are more into alternative assets, as you're saying, than a conventional portfolio. And the value of those drive, I would say the biggest thing is really, as you said, that diversification, where if you look at traditionally, you say, if I just have stocks and bonds, the only way to bring down my volatility is by bringing down my return. So if I'm willing to go from a 10% expected return to a 6% expected return, then I'll put a bunch of bonds in the portfolio. It'll be a smoother ride, probably. But if I say, hey, I don't
Yeah.
want to give up that expected return, but I do want a smoother ride, I think that's really where these alternatives come in. So if you look at something like, I would say the following are all, quote, equity like returns, which means that expected returns of, say, 10 plus percent. You could look at private equity, you could look at venture capital, you could look at private credit, you could look at oil and gas, litigation finance. Then you can get into the really more esoteric things like electricity trading, whiskey aging, sports team ownership, et cetera.
Yeah.
And but I'd say it's really mostly that of saying, hey, I want something that still has very strong expected returns where I can expect to get, let's say, low double digit over the cycle. And these things are less than perfectly correlated. So by balancing it out, rather than putting money into bonds, I'm going to put in these other things, which over time should give good returns. And I can talk a little bit about the how becomes much more important in these because it's harder to do than it is to go buy a stock.
Yeah. Yeah. No, I think that's really good. And I want to talk a little bit about and maybe this is too nerdy, but when we think about non-correlated assets, we think about the stock market and the bond market, and everybody sort of has this perception that when stocks are down, bonds are up, and vice versa, right? And or bonds are just kind of cruising along doing what they do, and they're a nice they counterbalance each other. But I think we rewind a few years, we go back to 2022, and we had a really interesting scenario where both you know, interest rates were up, inflation was kicking in, and the stock market was down. And so it was like we were losing money in the bonds, and we're also losing money in the stock market. And people are looking
Yeah.
around going, "I didn't think this was supposed to happen this way." And we sort of forgot because we'd been on a 40-year like interest rate decline scenario that you could lose money in the bond market. And so when we look at other asset classes that are non-correlated to the stock and bond market, the interesting thing that happens is because I think we need to pay attention to, um, when my portfolio is down 10%, it takes me 11% to get back to even. Okay. When I'm down 20%, it takes me 25% to get back to even. When I'm down 50%, it takes me 100% gain to get back to even. And so like those recoveries are just super painful to work through. And when we have a non-correlated portfolio, it smooths out the ride a little bit. I'm not down as, and again, there's lots of research out there on what happens when you have a non-correlated portfolio. You look at the Yale fund is at Swinson, and then Ray Dalio, some of these all-weather, portfolio construction guys have found out that like, oh yeah, you can smooth out the ride by having some of these alternatives in the mix. And it really does allow you to have better returns over the long term because you don't have those huge drawdowns. So I don't know if you have anything to add to that, but I think that information is worthwhile, and it's a really good reason to start thinking about how do I get more alternatives into my portfolio.
Yeah, I completely agree with that. And I think what's interesting about alternatives, partly there is the reduced correlation, and that totally depends on the asset. If you look at something like large cap private equity, that's going to be pretty well correlated because if KKR takes something private for $10 billion, the only way they can really exit that is to IPO it for 20 billion. And so their returns are going to correlate. There are things that are a lot less correlated. Like if you look at some trading strategies, let's say I'm trading some commodity or trading some electricity, it is really just a totally different thing that's driving my returns. That does not mean it's risk free. They can have a terrible year, they can be down 30%, but it
Mhm.
is differently correlated, as you're saying. I think most
Yeah.
things are probably litigation finance is another one. The
Yep.
risk factor there is really, am I going to win this lawsuit? Which
Yep.
has a pretty small amount to do with what's the state of the economy look like. I'd say most things are probably somewhere in the middle. If you look at something like oil and gas, which is one I like a lot, it has a lot of uncorrelated factors. Like you're very happy today if you're in oil and gas because every time the Strait of Hormuz is closed for another day, the value of
Yep.
your Permian oil goes up that day.
Yep.
But if the economy goes, most things are going to be dragged out to some degree with it.
Right. Right.
So I think it's partially correlation. The other interesting
Hmm.
things about this is I'd say sometimes people ask, hey, what is an alternative asset or private market asset? And really, the key difference there is that term private market, where if you look at stocks and bonds, and then some things you can access through those channels like REITs, there is really, you've got these regulators like the SEC making sure that there's very little fraud. You've got full information, and you have these hedge funds in Connecticut with all their supercomputers doing price discovery. So the price is always, quote, right. And I think the prices are, pretty accurate. When you get into these private markets, all those things go away, which I think both creates an opportunity and a risk. It means if you don't know what you're doing, I can just randomly pick 10 stocks, throw a dart at the wall, and I'm going to get the S&P return. Like it'll be fine. The prices are all accurate because other people are doing the work for me. If I just invest in 10 random hedge funds or 10 random VC funds, I am not going to do well. I'm not going to get access to the right ones. I'm not going to pick the right ones. And the profits are much more concentrated in those top quartile or top decile funds. They're not evenly distributed through the market there. So that's a real problem if you don't know what you're doing and you just kind of feel a sense of FOMO and want to just, quote, do something. But on the other hand, it creates the opportunity where if you can actually get access to the top tier ones and understand how to underwrite them and get access to the right fee structures, then there's the opportunity for really getting alpha, which I think is almost impossible to do in public stocks. I am not going to better figure out what NVIDIA's profits are next year than some guy at a hedge fund.
Right.
But that's different in these private markets. They're not so efficient.
Yeah. No, that's great. And can we talk a little bit about liquidity for a minute? Because I think
Yeah,
there's a liquidity premium put on public markets, right?
for sure.
I can turn my dollars into, or I can turn my investment into dollars like anytime I want. When we think about somebody that's had a liquidity event, and I think goes back to your discussion around your comment around, they hold a relatively small percentage of their assets in bonds, and we can look at that and go, the reason they do that is because they only need a small piece of their portfolio to sort of manage their financial freedom, right? The rest of it is legacy money that can grow for a long period of time. So I've got assets that are positioned outside of what I'm going to need. They're long term. Can you talk a little bit about we'll call it the value of it being illiquid? Because I think there's some actually some good value there
Yeah.
because I don't have that liquidity premium. And also maybe I think this is maybe underestimated. There's also a value of not having all of the government oversight and sort of cost of having a publicly traded security as well. So I don't know. Can you touch
Yeah.
on those two things? Yeah, thank you.
It's funny where I thought you were going to say there was there can be a behavioral benefit to illiquidity where if you're in the middle of COVID and your public portfolio drops 40%, there can be, not for everyone. There's some people who are perfectly stomach it and just say, hey, stocks are on sale. I want to buy more. But there's a lot of people who say, hey, I can't take the pain anymore. I'm going to,
Right.
push the sell button here.
Yeah.
And if you are in a venture capital fund, your assets, you're probably just as worried about them, but you can't do anything about it. And I think that's
Right.
why for a lot of people, actually, their house can be their best investment because you're not panic selling. I don't know,
Yeah.
I'm here in Dallas. Maybe real estate's gone down 5 or 10% in the last year. I'm not
Mhm.
doing anything about it. I'm not worried. I'm still living in my
Right.
house. And so I'm going to get that long-term return.
Yeah.
Again, this isn't everybody, but I do think for a lot of people that illiquidity, it's funny. Fidelity did this study of who their very most successful investors were. And number one on this list, you're smiling, maybe you know this, it's people who are dead because they don't trade at all. They just get the long-term return. And
Yeah.
so you both do, as you're saying, you get paid by the market. You get rewarded for the liquidity, but I think it can drive some good behaviors there. And now the downside, yeah, I would not advocate that many people go to 100% illiquid. I think there is a lot of benefit to that liquidity. Or even there's other things you can do with, if you've got 5 million public stocks and you want to get a mortgage, well, I can move my money to Wells Fargo. They'll give me a discount on my mortgage. So I think it's really nice to have that pool there. But for the money that you don't need right now, one thing that people, not everybody, but some people who makes them feel better about that is they look for stuff that generates some income. And whether that is private credit, again, oil and gas, there's a number of these strategies, hedge funds, where it may not be liquid, but I know if I'm getting 5 or 10% distributions every year, I feel much better about that money being locked up because I'm still seeing some cash that I can either spend or reinvest.
Yeah. Yeah, this is good. And I think one thing, it's really, really hard for almost anybody to see a 40% drawdown and not want to take action. And I think the reason being is our brains are wired to run away from danger, right? When a bear is chasing me, I'm going to run away from that, and that's what a 40% drawdown feels like. It's like, oh, this is danger. I need to get away from it. Now, intellectually, we can know that things just went on sale, but there's this nagging thing that we tend to see that this time is different. This is when it all falls apart. I better get my assets and move it to something safe because
Yeah, yeah.
I'm experiencing all the pain right now. And so and another reason, I think it is nice that, going back to the house example you gave us, I don't have a meter when I walk up to my house to know what my house value is. So it could drop 10% in value, but since I'm not seeing that displayed every day, it's not really bothering me. It's something I really got to go look up. Zillow's made that maybe a little more easy to see the value of my property, but and it's not as easy to like make a phone call or click a button and make that sale happen. So I think those things are all like really good for protecting the investor from themselves, from making those more emotional decisions. So
The other thing
um,
that I found personally on this front is,
mhm,
while I think that Vanguard and totally passive zero cost index funds are great, I think the one downside is it makes your money a little more abstract. Like if you say I've got $10 million in VTSAX, well, I don't. That doesn't really mean anything to me. And now, if I just
yeah,
see every month for 2 years that number is going down, I feel like this is a terrible investment.
yeah,
Whereas this could even be individual stocks. I know, oh, if I own $1 million of Exxon and I see that now dropped to 500,000, but I know, well, they still own all those oil fields. They're still producing just as much oil. They're still paying me the same dividends they were before. It feels more tangible. And I think that's also true in this private market side, where by the nature of them being more concentrated and people research them more, I think they often understand more what they're investing in. So they say, okay, if I'm in this venture capital or this private equity fund and I know these are the 5 portfolio companies, both I can't sell even if I wanted to and have that bad behavior, but I'm probably also less inclined to sell because it's not just this ticker that doesn't really mean anything to me.
yeah. And I think that can work both ways on analyzing the opportunity. I remember Sun Microsystems CEO back in the tech bubble burst, or tech bubble of early 2000s, late 90s, early 2000s. And he publicly said, like, I don't know why anybody's investing in our company at this multiple, right? It was trading at like 20 times revenue, like 20 times sales. And he
Yeah.
was like, we have to fire all of our people and still produce the same amount of revenue. And it's going to take 20 years for you to get your money back. Like, that's insanity. Like, nobody should make that investment. And so
Yeah.
I think there's some when we invest in, the total stock market funds through Vanguard, we're making some of those investments. Some of those companies at the top end that, Logic has left the chat, and, people are just keeping pumping money into it. And we're by default investing in those. And we're actually maybe investing a lot of money in those because, it's weighted, it's cap weighted. It's not like
Yeah.
I'm investing.
You're
Yeah.
Tesla at $1 trillion. You're buying Tesla at a trillion, whether you think that
Right.
they're, yeah, even though they're losing market share in the auto industry.
Okay. Right. And there's, so I think that's, I think that's one side of the equation. And then I think you nailed the other side. Like, I can make a decision and I can look at the market making foolish decisions and go, look, I can see the underlying assets here. The dividend's still healthy. I'm okay holding on to this thing long term because of all of those factors. It's a solid investment that I'm in for the long term. Back to that Fidelity study you cited, that people that just hang on tend to do really well. I'd like to venture into private credit a little bit. Can you just define
Yeah.
that? Because I feel like that's It's a pretty
Yeah.
broad category, and it'd be good to just sort of narrow this down a little.
No, it's really interesting. And I will say, actually, if people want to dive deeper on this, for those who've been nerding out on it, private credit has been getting crushed recently. And we actually, I host a podcast called Navigating Wealth. And coming out this Friday, we've got an interview with one of the senior people at Blue Owl, which is one of the big, $100 billion private credit funds, and one that has been sort of a poster child for some of the bad press. And we really dove with her for about an hour into what are all the mechanics that have been driving the recent private credit issues. So people may, again, that's going to launch this week. People may be interested in checking that out. But generally, what private credit is sometimes pejoratively called something like shadow banking. But what it really is it's if I want to borrow money and I'm a big company, I could, in theory, go to a bank to borrow that money. It happens more in Europe than the US. I could issue bonds, which happens a lot if I'm a big company, or I can go borrow from one of these private credit funds. And generally, I'm going to pay a little bit more there. Let's call the interest rate. It's, it varies depending on the whatever treasuries are at, but let's call it maybe 10% being a, quote, normal private credit rate. And it is typically done actually by private equity firms. So if I'm a KKR or a Carlyle, somebody like that, I want to buy a company for 10 billion. I will probably put in 6 billion of equity, and then I will go borrow another 4 billion of private credit. Those ratios can change depending on what I'm buying, but it's a way for them to enhance their equity returns. And then the private credit lenders say, hey, or the people investing in those loans will say, I'm going to get a 10% return here, and I'm much safer position in the capital stack. So I'm perfectly happy to get this. That's basically what it does. I would say and this has really grown over the past 10 or 20 years. I don't know what the numbers are, but let's call it a 5 or a 10-fold increase in the amount of this private credit lending. I think that's made a lot of people nervous. They said, hey, it tends to end poorly when you see loans on anything growing 10x over the course of a decade or 2 decades. That's often a recipe for failure. And so I think people are poised to say there's going to be a challenge there. There's also been a couple of fraud cases that actually turned out to have almost nothing to do with private credit. If you look at Tricolor or First Brands, those were actually bank loans, but people sort of conflated things and said, oh, that must be a sign there's problem in private credit. So people keep looking for this disaster to happen. And then there's also been some stuff recently around software stocks being hurt by AI, and a lot of the private equity owned companies are software companies. And so question, hey, is that going to cause problems here? But, without getting probably too far into the weeds anyway. But basically what you're doing if you're an investor in private credit is you are giving some big company, like let's call it Golub is one of the big names there, Blue Owl. You're giving them $1 million and they're turning around lending it to private equity companies to help finance these buyouts. And you're in a privileged position on the capital stack there. And that's performed very well. The biggest, and I know that you're very into tax optimization. I think the biggest challenge you see with private credit is it throws off ordinary income. So if I'm living in California and I'm a high income earner, I've got effective 50% tax rate. So if I'm seeing a headline 12% return, that's really only 6% after tax. So it's okay, but it's not great. What I think is actually the most interesting way to go about this, and you need a bigger portfolio to do this, but you can invest in private credit through a private placement life insurance policy. And now I am not a permanent life insurance guy. Like if you tell me, should I buy whole life? I'll say, I don't need to know anything. The answer is no, you should not buy whole life. But private placement life insurance is much lower fee drag just because of the nature of it. It's about a 1% fee drag, all in broker fee, cost of insurance, all the different fee layers, call it around 1%. But then it makes the whole thing totally protected from taxes. So if you have that headline 12% return on your private credit, it goes down to 11% after tax, not 6% after tax. So you actually have a huge opportunity for arbitrage there. You do need a lot of money to make this work. Typically, they'll have like $5 million minimums. We're actually doing something within the community. We're putting together a group plan where we can get those minimums down to more like $1 million, which I think we haven't launched that yet, but a lot of our members are interested in. So I think we are going to try and do a sort of collaborative thing like that. But that's basically private credit. The big knock is the tax inefficiency. And then,
No, I love that. And we do have some clients that we think private placement life insurance makes a ton of sense, especially if you've had a large exit and it's like, okay, I love the tax wrapper of life insurance. When you think about what life insurance does, it creates all sorts of unique tax opportunities. And so it's like, how do I leverage those to my favor? And private placement life insurance is a unique way to do that. So we've had a few episodes on the podcast on that. And I think it's a fantastic tool, and I love how you're thinking about it. Because if I have some after tax dollars, now all the after tax dollars shouldn't be in life insurance. by any stretch, but it's like it is a unique place to hold those maybe
Yeah.
tax inefficient assets that
Yeah.
you
And
know.
I think if you look traditionally, somebody might say a 60-40 or an 80-20 portfolio. I would say with that 40 or 20% being in bonds, personally, I would say that should be in private credit because you're still on the lending side. You're still further down the capital stack, but you're getting much better expected returns than you are with bonds. And I would say also multi-strat hedge funds. So big names there, things like Millennium or Citadel or Jane Street, Hudson River Trading. They don't have shoot the lights out returns. You're not going to make 30% a year, but you could make probably 10% a year in a consistent, repeatable way that, again, is low correlation to your point there. And so I think that idea of putting 10, 20, 30% into these, again, 10% expected return, lower correlation, private credit and multi-strat hedge funds are a great way to go about that. If you can get access, they tend to have very high minimums.
Yeah. Yep. No, I think that's great. And I also have seen private credit include everything from like, some mezzanine debt for real estate financing to, also, um, you know, yeah, I've seen it levered into
Yes, it can be
some of the real
secured by
estate side too. Yep.
yeah,
So,
or all kinds of things. I mean, I we also like some of those nichier ones. So I think you and I were talking about before the show where a lot of times in our community, once or twice a month, we'll sort of put together some pooled feeder fund where say, hey, a lot of people are interested in this investment, but they don't want to hit a 10 million minimum. So I'll have 100 people each invest 100,000 hit that minimum. And we've seen some interesting things on the private credit side. These are a lot smaller. It's not like the Blue Hour or the Golub. They're managing $50 billion, but a fund of maybe 100 million. Well, they'll be secured by some interesting assets. So whether that is whiskey sitting in barrels that's aging as your security, that could be SaaS receivables as your security. We've actually done some interesting stuff in cannabis lending because you get, again, these niche things, you get interesting dynamics there where because of federal regulations, a bank can't lend to cannabis. So you have these lenders who are extremely bankable where they've got positive cash flow, they own their own real estate, and they're still paying you 15% because they can't go through the traditional banking system. And so again, it doesn't work at huge scales, but you can pick up some of these arbitrage opportunities on the smaller scale there.
let's take a quick second here because I want to hear from you. One of the biggest goals of this podcast is to bring you conversations that actually matter, not just what we think is important, but what you are dealing with right now as an entrepreneur. So if you've got questions around tax strategy, investing, exits, or anything we've talked about in this episode, head over to vitalstrategies.com/questions and submit them there. That's vitalstrategies.com/questions. We're actively using your questions to shape our future episodes, bring on the right experts, and go deeper into the topics that are most relevant to you. We're also answering these in our newsletter. So don't just listen, be a part of the conversation. Go to vitalstrategies.com/questions and let us know what you want to learn next. Now, Ted, one thing I think is interesting is I was actually on a call with a client of ours that has a Goldman relationship, and we were talking about alternatives and what percentage of our portfolio should be allocated to alternatives. And I've got opinions on this, and I've heard, we've got a number of clients in Tiger 21, and Tiger 21 will release their, I'll say typical member portfolio. They'll look at that. We've also seen some studies done on, billionaire portfolios and what percentage of their assets they're holding in alternatives. And then you sort of move down the scale. And it's surprising to me that, maybe an ultra high net worth advisor is saying, hey, have a small percentage of your assets in what we'll call these alternatives. And so I'm curious if you have thoughts or opinions, or if you've seen discussion in the community one way or the other on, what percentage of my assets I should hold in alternatives versus like traditional stock and bonds.
Yeah, I got two thoughts on that. One is we do, as I mentioned, this annual survey. So we have, hundreds of people responding every year of saying, hey, what is and we ask across 60 different categories, what's your allocation look like? So in general, those private market assets, if I define that broadly, it's about 30% of their assets. Now I'm including in their investment real estate. We can argue, and that's maybe 10 of those 30% are investment real estate. We might argue that owning a rental property is not a private market investment. So it could go either way. That also includes a lot of, like in your case, ownership of private companies. So as an entrepreneur, maybe half of my money is in this private company, and that wasn't necessarily an intentional allocation. It just sort of grew into that.
Right.
But
Yep.
if we leave those aside, I'll call it maybe 15-20% of money in these private or alternative assets. Now, one thing that's interesting is you said, hey, why would Goldman Sachs, not tell you to put it there? I'm not somebody who is categorically opposed to wealth managers. I think earlier in my career, I had this sort of religious opposition, and now I see a lot more benefit they give. Maybe somebody is too busy, maybe they're not interested, maybe they're getting older, maybe they're worried about their spouse taking over if something happens to them. I think there's a lot of very good reasons why somebody can go with a wealth manager. But I think the biggest risk of conflict of interest is just the fee structure, for reasons we can get into, is based on assets under management. And again, I used to think that that was a truly criminal thing. I've come to terms with the fact that I don't work with one, but that's how they charge, is a percentage of assets under management. But what it means is they are just fundamentally incentivized not to recommend you to invest in something they can't manage. So as I mentioned, we do these syndicated or kind of feeder funds in our community where we say, okay, this looks like an interesting one. Let's see if we can pool money to get together there. I notice whenever somebody leaves a comment of, hey, I'm going to go talk with my guy about this, 100% of the time, no matter what the investment is, their guy says, don't put money into it because he can't collect a management fee. And even if he's not thinking that consciously, in practice, like, oh, we'll go with Credit Suisse's version of this. We have a version that's like this. And even if it's not quite as good, he's going to tell you to go with that version. Or again, should I buy this warehouse? Well, there's no way Goldman can charge me, for owning a warehouse. And so he's going to say, no, don't buy that warehouse. Put it into this REIT that Goldman does, or put into this public REIT that I can charge an AUM fee on. So I think that is probably the biggest knock I would have, is it's just very hard for somebody. I think there's a quote from H.L. Mencken that it's very hard to make a man understand a thing if it is counter to how he earns his salary.
Yeah. Yeah, I was going to say there's a really good book out there. I believe it's Influence the Psychology of Persuasion, and they start looking at, as soon as my financial incentive is tied to an outcome, my advice is going to be favorable to that outcome. So
even good people trying to do the right thing. I'm not saying these are bad people by any means, but that is just what happens in practice.
Yeah, and I think it's also true the other way. Like, even if I've already been compensated, we think about, we'll call it our politicians and lobbyists and that type of thing. If I was paid, $500,000 to go speak at this convention, now moving forward, I'm going to be favorable towards that particular organization. So yeah, I think those things are, I think they're undervalued. They're not. People aren't paying as much attention to those as they should when they're receiving advice from people like going with. And I think Nassim Taleb does a great job of sort of beating up on some of those things as well. So,
and now I will say again, not speaking as wealth manager, because that's not what I do. But the reason I've come around to it being okay to do this, to charge based on AUM, is we spent a long time looking on behalf of our members. Hey, can we find some really good wealth manager, top tier, who charges just a straight hourly fee? It's like, hey, my lawyer charges me by the hour. He doesn't charge 1% of my portfolio. So why can't you?
Yep.
And I think what we ultimately came down to is there are not that many really good wealth managers out there. And so there is more demand than supply. And if you are smart enough to be a good wealth manager, you are going to go with the client who's willing to pay you a lot, not the client who's only willing to pay you $10,000 a year. So I think it's like that quote about, I wouldn't want to be a member of any club that would have me. I wouldn't want to be a client of an advisor who is willing to take 5,000 a year when he could be taking 50. And I think that's really the core thing. So you just, if you want that, you got to come to terms with paying for it. Again, I'm not willing to, but I don't think there's anything wrong. I tell my wife, if I pass away, you should hire a guy like that.
Sure. Yeah, no, I think that makes sense. And when I also think about how we like to structure our engagements, and we have flat fee consulting because I like it better than the hourly rate, because when it's hourly, you're not incentivized to call me. Where when you're paying me a monthly fee, you're incentivized to call me about every possible thing, and we're meeting monthly. And so we think that makes sense. And then we cap our AUM fees as well, because it's like, look, after a certain point, we're pricing based on complexity, not the value you're bringing to the equation. And we like to quantify our value. So,
I like that.
So we think all of those things make a lot of sense. And then the final piece, I think commissions just are problematic across the board. They're challenging. And so we we just donate 100% of all of the commissions we receive to charity because we don't take them every opportunity we can, but there's some things like if somebody needs disability insurance, I can send you out into the marketplace. Now we've got the conflict out in the marketplace, or we can just place it for you and take care of it that way. So yeah, I think this is good. This is a lot of fun. All right. So I'm also thinking about, and this might be a question that's too hard to answer, but is there a like when you start looking at these private investments, here's sort of the entry point. This is something you should consider first, and then there's like
Yeah.
a stack that you continue to work your way down as you continue to progress in the private investment space.
Yeah, it's a great question. And I would say, I think if people are interested in this, joining our community, there's no membership fees in our community. So if you're interested in joining, you can go to longangle.com and apply there. So I would say, because we do a couple of these every month, and we share all of the diligence materials, all the recordings of calls with the managers, et cetera. If people just want to learn about it, they don't have to participate in any of these pooled vehicles, but it's a good way to learn. So I'd say the first thing is to learn about it. And then I would say, in terms of how to go about it, it's probably important. There's two ways you could do it. You could just say, hey, this is interesting. This is sexier than stocks. I see this cool venture capital thing. I've heard of Lightspeed. I want to invest in Lightspeed. I'm just going to go ahead and do it. That is probably not the ideal way to go. I will admit I fall prey to that at times. I've got a buddy who's starting a biotech and I think he's really smart. And so I'm going to put some money in there. It's not going to be a smart portfolio allocation, but it's just something that I want to do. I think if you're talking significant money, the more responsible way to do it is to think about what will this do for my portfolio? Is it something that I believe will have higher expected returns than the rest of my portfolio? Let's call it, I think this thing has historically delivered 15% IRR. That's better than getting anywhere else. So that's what I'm trying to do. Or as we talked about, is it this diversification play? Is it a superior tax treatment? So to think about that. And I would say broadly, you can put these things into a couple of categories. One is equity-like instruments. So if you think of public equities, public stocks as sort of one end of that spectrum where they're the largest companies, they're the most liquid, you can then basically just keep going all the way down the spectrum and you will get smaller and smaller companies with less and less information. They probably have, on an individual company perspective, higher and higher risk. But if you have a portfolio, you're not necessarily doing that, and you're probably going up on the expected return. So the other extreme would be venture capital or angel type of investing, where you have extremely long periods. It's probably a decade plus till you get your money back, and you're probably going to have 90% of them fail. But you could have, if you get into the next Anthropic, you're going to have phenomenal returns. So if you have a big enough portfolio there. And then basically in the middle, it's just where you want to go. So another one on the small side is something like search funds. I'm not sure if you're familiar with those. That's basically that it's a really interesting asset class that's historically had phenomenal, like 30% returns over multiple decades, where you are getting some real smart graduate of Harvard or Stanford Business School. You give him or her, or you collectively, a dozen investors give him or her a couple $100,000 a year to sort of fund their lifestyle and fund their search as they look for a company to buy. And that gives you right of first refusal to participate in the purchase when they make it. And they're typically buying a company that has maybe a couple million of earnings, and they're buying it 4 times. And then you have this energetic, smart young guy who then takes it from 2 million of earnings to 5 million of earnings. And the multiple, as it gets bigger, goes from 4 times earnings to 10 times earnings. So he can get a 4x, 5x return over 5 years without working in magic, just sort of by hard work there. And you've seen that, continually compounds over time. You get things like, I really like roll up private equity. So there's, a bunch of that on the equity side. Then you've also got a lot of, then there's just kind of we talked about the credit side, just these different flavors of debt and how much risk you're willing to take versus how much return you want. And then you've got the sort of long tail of other investments. As I said, I really like oil and gas. I think it's one that puts a very high premium on getting in with a good operator there, because the best operators, if somebody comes to you, if you're a dentist, somebody comes to you pitching a tax treatment of oil and gas deal, I would say, run, don't walk away from that. But if you can actually get into the ones who are really delivering the best returns, the ROE on drilling wells can be, 70 to 100% ROE on that, if they're properly hedged, et cetera. So
Yeah.
long-winded way of saying I would start with the research, but I think the biggest thing is probably the process of how am I getting access to this opportunity? Is it something that somebody's just coming to me to pitch? And then you really have to think about why am I, as let's say I run a plumbing company. If I'm getting pitched a biotech VC deal out of the blue, that probably meant that all of the people who understand biotech VC passed in this deal and is now getting to the
Yeah.
head of this plumbing company. On the other hand, let's say I am, C-suite at Eli Lilly and somebody's coming to me. Well, I may have they're coming to me because they want the access. I can really understand this deal and I may get great returns. So most people have a relatively small circle of competency. Again, if I run an oil company and I'm seeing another oil and gas deal, it's probably a good oil and gas deal. And if not, I
Yeah.
can analyze it. Or can you find a way to consistently get access to things outside your personal sphere of competency? That's certainly what we try and do within our community. We say, hey, we've got 8,000 people who've made money in all these different industries. So we have people who have access and can help us underwrite these opportunities.
Yeah.
Or maybe, again, you have a good wealth manager who you really trust and that person can give you that access. But I think it's really thinking about your process and your access rather than just blindly saying, I want some sort of private exposure.
Yeah, no, I think that's good. And one thing you touched on was underwriting, and I think the underwriting. One question I have about underwriting is we've seen amazing opportunities on the spreadsheet, but at the end of the day, it all comes down to execution. Like, who are the people executing on that strategy? And so, how much of the underwriting and how much does the community get involved in going? Okay, let's do our diligence on the people that are executing on this strategy versus just believing in the strategy.
Oh, 100%. That's critical. And I think there are, in our experience, we have learned over the past several years, been doing this, two patterns. One is we don't really go with anybody who's maybe under 100 million of their fund size and somebody who's on their first fund. We typically really look for more like the second, third, fourth fund, and probably in the, a few hundred million to a few billion, where it gets big enough, you don't have this key man risk of what if Patrick gets hit by a bus and now there's nobody to run the company.
Sure.
You bring down your fraud risk, all that sort of thing. And so I think it's that. And then specifically, okay, you could have a lot of different things on their third fund with $1 billion of AUM. Doesn't make them all good. There, we do really try and take advantage of the community. I'd say both for access and for the underwriting. Some things are pretty easy to underwrite. Like if you're looking at multifamily residential, you don't have to be a genius and a real estate savant to understand what the dynamics are, how interest rates move things, absorption rates, et cetera. But if you get into these things, like I said, litigation finance or oil and gas, a person who doesn't work in that, it can be harder from the outside to really separate who are the good operators from the bad operators. What are the metrics that you look at? And so we will try and, if you look at private equity, for example, what we will typically do there is we have one, we'll look at their track record and say, okay, this fund has, there's a fund called Levine Lichtman that we've invested in that I really like. They've got a very long track record of posting great returns. But then what we did there is we want to explore it more. We asked a member of our community who knows the principals there for an introduction. But then we also talked with members of our community who run portfolio companies there. And we said, okay, you're the CEO of a portfolio company that's owned by Levine Lichtman. What's it actually been like working for them? In your experience, how have they added value? What dumb decisions have they made? Would you personally invest in their next fund? And so that gives you that kind of, I don't want to say inside information in the unethical sense, but just a richness of information you can't get from looking at their deck. And again, by having 8,000 people, we've kind of got those connections everywhere. And those are really helpful in kind of avoiding bad deals.
Yeah. Yeah. No, that's fantastic. Cause we've, being in the entrepreneur space, being an entrepreneur myself, seeing lots of deals come and go throughout my 25 plus year career, looking at opportunities. It all boils down to the operator and their track record, and I personally, so we've got an extensive real estate and background in real estate. I bought deals that on paper were home runs, and then at the end of the day, our execution wasn't exactly perfect and turned out to be an okay deal. And then we had other deals that on paper looked okay, and we executed really, really well, and they were home runs. And so it's like, okay, I can even look in the mirror and go, yep, it all comes down to how well this deal is executed. So,
and I would also say, especially, I'd say the further out into the weirdness spectrum you're getting, and I know weirdness doesn't sound like a scientific term, but you kind of know when you see it. If you're talking about like leverage crypto trading, that's a weird thing. The further in the weirdness spectrum you get, I think the more you need to have somebody who really understands it. So we have an example of one, I won't name it, that we looked at, but it was in this crypto Forex trading. And on the surface, you're like, man, this thing's phenomenal. It's posting 10% a month return. Initially, we said, okay, well, we shouldn't even look at this because it's too good to be true. It's too good to be true. And they said, well, if you look at the names, the principals here, these guys are, senior nuclear researchers. They were senior AI execs at publicly traded companies. Maybe this is the mythical $20 bill lying in the sidewalk and we should pick it up. So we double clicked on it. And what we did there is we had some people on our team who'd actually run their own Forex trading firms and made hundreds of millions of dollars before they retired. And we said, hey, can you help us really analyze this? And so we got down to getting the trading logs of the minute by minute transactions from some sample days saying, hey, how are you actually posting those returns? And what's really interesting is they had indeed been posting the returns. It wasn't like they were lying about it. They were making a very consistent 0.5% to 1% a day. So it was this incredibly smooth, upward linear thing. But then when you dug down into it, we realized they didn't realize how much risk they were trading, where on a minute to minute basis, they were up 20% 1 minute, down 30% the next minute, and basically just closing each day when they're up 1%. And so it had this appearance of smoothness. But what one of the members of our deal team who'd run his own fund, there was a similar strategy, said, look, this is going to, for years and years, post a very smooth 1% a day or 0.5% a day. And then one day, boom, it's just going to go to zero because it's like black came up too many times in a row and all of a sudden the whole thing is wiped out. And so, you could not get that by looking at the track record because it looked unbelievably smooth. There were no such thing as a down month. But if you get into these weird things, again, you don't necessarily need to do this if you're buying a fourplex apartment building. There's not some weird tail risk like that lurking. But if something really complicated, you need somebody who really understands it to, help you understand the risks.
Yeah. Tad, this has been incredible. I think the community you've built is fantastic. When I think about these opportunities, for a lot of the reasons, I don't see any downside for somebody that's got some tremendous net worth to go just apply at longangle.com. I think you guys are doing some really cool things, and also your Navigating Wealth podcast, I think, is fantastic as far as like a resource. You got so many resources on your website that people should check out. Longangle.com. The resources section, like you can spend hours and hours and hours, days and days digging into these things, and I think becoming a member is a key piece. So when I think about the stakes, right? If I'm not taking action on this, I'm overexposed either in my business or potentially the public markets, and I'm missing out access to better opportunities. And there's also a wealth building inefficiency that's taking place if I'm not taking opportunities to look at these private investments for the reasons we talked about, smoothing out the ride. And I might be taking unnecessary risks. When I've just got a stock and bond allocation, there's nothing to counterbalance that. So I can end up, especially if I'm holding all sorts of wealth in my business. We think that's a great way to grow your wealth, but at some point I need to start taking some chips off the table and moving them into something that is not tied to my business. And so I can be rich on paper, but not diversified or secure. So we think that's a wise thing to do. And then when I do take action on sort of just digging in and educating myself and understanding the opportunities that are out there, I'm building a diversified and hopefully resilient portfolio. I'm giving myself access to higher quality investment opportunities and better decision-making. We think about the hive mind of 8,000 people that have been there, done that, and being able to share that intelligence, I think, is important. And then, we think about the wealth that we do build. It supports our freedom, our family, and this legacy that we're trying to build. So I think what you're doing is fantastic. Any last thoughts or comments before we wrap up?
No, I really appreciate the opportunity to have me here. Agree with everything you said there. Your listeners who are interested in following along, would love to hear from them if they want to get involved in the community. And really appreciate your time today.
Yeah, no, this has been fantastic, and I'm definitely spent some time on longangle.com, but going to be spending some more there. So, Tad, this has been wonderful. Appreciate what you're doing in the marketplace. I think this is important, and valuable.
All right. Well, thank you, Patrick.
All right. That's a wrap on today's episode. Thank you for tuning in to the Vital Wealth Strategies podcast. I hope you found real value in this conversation and walked away with insights you can actually apply. If you did, share this episode with someone who could benefit from it. That's how we continue to grow this community of like-minded entrepreneurs. And if you're ready to take things a step further, make sure you visit vitalwealth.com/resources. We've built a powerful toolbox of tax strategies, wealth building tools, all designed specifically for entrepreneurs like you. Again, that's vitalwealth.com/resources. Go check it out and start putting these strategies into action. If you haven't already, take a moment to leave us a review. It helps us reach more entrepreneurs who are serious about building wealth and living intentionally. And remember, you're a vital entrepreneur. You're vital because you're the backbone of our economy, creating opportunities, driving growth, and making an impact. You're vital to your family, creating abundance in every aspect of life. And you're vital to me because you're committed to growing your wealth, leading with purpose, and creating something truly great. Thank you for being a part of this incredible community of vital entrepreneurs. I appreciate you and look forward to having you back here next time on the Vital Wealth Strategies podcast, where we help entrepreneurs minimize their taxes, master wealth, and optimize their lives. All right.